Hi, everyone. Thanks for having us. I'm Sonali Basak. I'm a Bloomberg reporter. I focus on the insurance industry in the US and abroad. I'm very excited to have my panelists with you today. I've gotten to spend some time with them throughout the years and also throughout the last couple of weeks a lot. So here we have Daniel Schreiber, the CEO of Lemonade. He focuses on home and renters insurance, while Dan Preston at Metromile focuses on the auto industry. Jamie Hale of Ladder focuses on life. So I'm really happy to be able to provide with you three different perspectives of all insurance, but very different aspects of the insurance industry. To get us started, something I really thought was interesting is the three of them actually come from very different backgrounds and mostly not insurance. So given that they have created three very successful insurance startups in the industry so far, I wanted to ask them each why they chose this industry in the first place for disruption. You want to get us started, Dan?
Sure, with pleasure. Good afternoon. So I've been in tech for 20 years. I'm a recovering attorney. I've been clean for 20 years, but been in technology since then and was looking to do something big for kind of my next startup. And I joined forces with my co-founder, Shai Wininger, and insurance was honestly not high on the list of sectors that we were looking at. But when we encountered it, we encountered a space that had three characteristics that seldom come together. One is, of course, this is vast. It's measured in trillions, whether you look at household penetration, which is as near to 100% as matters. So a huge sector. Then the next one is unspoiled by innovation. So as you said, we're in homeowners insurance. The top 10 homeowners insurance providers in the US have an average age of 104. And their business model is really the byproduct of an industrial revolution. It's managed to withstand almost every revolution since then. And again, as an entrepreneur, finding a sector that is relatively unchanged was tempting. And then the third piece is you say, well, if it ain't broken, don't fix it. But it's deeply broken. This is one of the least loved sectors. It's providing a profound social good, but isn't perceived that way. Brand loyalty is terrible. So the combination of those three, huge, unchanged, and unloved, was too much to pass up on.
It's funny you say that too, because when you think of brand loyalty, you think of Geico, right? And you think of Progressive. And Dan Preston has entered the auto insurance industry with massive players. Why did you choose the auto insurance industry? And given your background is in machine learning, right? So where did you see the opportunities for disruption here? And how do you mix your background with that?
Yeah, so my background is in machine learning and statistics, and focused on a number of different problems along the way. And I actually originally joined Metromile as the head of technology very early on when we were first launching the product. And what intrigued me about the business was that the way that we were enabling the per mile insurance product was through this device that plugged into the car's diagnostic port. And all of this data we were capturing would turn out to have a lot of value, not only to the insurance business and building a better product, but also in enhancing that with other features and other opportunities that we could build on top of it. And so I joined initially in the promise of that becoming very important to the business and leading that. And I moved into this CEO role over the following year after that, as it became obvious that the core of what we do is leveraging machine learning and AI towards the core part of the business and using that as the true differentiator in the long term.
And Jamie actually comes from another topic that's near and dear to Bloomberg, investments and investment banking. What brought you to Ladder Life?
Well, for me, it's a little bit more of a personal story. So I started actually my career in product in a technology company and then was in investments for quite a long time. And my friends would come to me trying to figure out their financial life. And for them, one of their biggest needs is life insurance because they're having babies and getting mortgages. And they would always come back really frustrated they couldn't buy it online, frustrated that it took 8 to 10 weeks to get an answer. And it's personal to me because I'm a beneficiary. So my dad died when I was 11, and we had a life insurance policy and did exactly what it was supposed to do. Kept me in my house around my friends during a super tough time. Helped get me through college. So, as you mentioned, Daniel, life insurance is fundamentally almost a social good. It is fundamentally too important not to see innovation. And I think all of us are trying to drive that and make that a little bit better.
All three of you had something in common when you talked about the branding problem in insurance. Nobody looks at insurance and says, I really want to buy that, right? It's not like a Tesla. So when you are thinking about gaining customers and expanding, really, right? Yeah. How do you make insurance something that millennials want to buy, for example?
So what's interesting for us is when you have a kid or you get a mortgage and you're doing life together with someone, about 90 or over 90% of our customers actually know about life insurance and actually think it's fundamentally good and necessary. So what's nice is they're already thinking about it. So we just get to have the conversation where they already are, which is online as they're thinking about it. And we can do it outside business hours. We're always available. Over 60% of our policies are actually issued outside traditional business hours. So for the modern consumer, the concept of going in and meeting an agent during business hours and filling out a lot of paper forms and having to pay that higher expense because of those old technology, that's an anathema. So what's nice is we're proving the adage wrong. Right? Life insurance is actually bought. It doesn't actually have to be pushed and sold.
Do you want to add on to that, Daniel, as well?
Sure. In beginning to think about Lemonade, in the nascent stages of our development of the idea, we really pondered that question for a long time. What is it about insurance that makes people not like the sector? Why is it sold, not bought? Why is it something that people perceive as a necessary evil rather than a social good? And one of our founding team members was Professor Dan Ariely, the behavioral economist, and he's written about this extensively and studied it. So there's about 10 years of social sciences behind what I'm about to say. But at its core, at least in our telling, one of the challenges that insurance faces is a conflict of interest, or a perceived conflict of interest for sure, at its very core, whereby when you make a claim of me, the insurance company, if I deny your claim, I get to pocket that money, which pits me against you, then you embellish your claims, and I'm going to fight you for it, and it spirals onwards and downwards. And it's very difficult to create a lovable brand atop that kind of foundation. If there's a conflict of interest at the core, it's going to manifest itself surely one way or another. And for that reason, for hundreds of years, insurance has been perceived the way it's still perceived today, which is unfair. It's run by good people trying to do good work, but there's something, the players aren't the problem, the game is the problem. So for us, part of the challenge was, could you change the game? Could you change the business model? And in our case, we do that. So we don't make profit from underwriting profit that's donated to nonprofits. A bit of a tongue twister, but you get the idea. But really trying to address some of those underlying questions of why is this not loved? Why is there no brand loyalty? Why is the best-selling proposition today still that 15 minutes can save you 15%, when that is a fundamentally, it's a great company doing great work, but that's a fundamentally commoditized message, isn't it? It's all about price and a few minutes. So I think those are really some of the profound questions that the whole sector faces today.
Something interesting that you guys have done that we haven't seen a whole lot of in the insurtech space, we were just talking before this panel about how in the last year and a half we've seen a proliferation of them, but very few companies have chosen to be a carrier, to directly write insurance for their customers. You know, from where we're sitting, we understand there are a lot of regulatory hurdles to that as well. Wondering, you know, Metromile, Dan, you were one of the first to really do this and make the decision. Why did you do that, and how did you think about structure moving forward?
So we made this decision not lightly, for sure. We had identified a number of the sort of biggest challenges for our customers and their experience with us. And going to the earlier point of what, for instance, millennials are really looking for in an insurance product, the pricing that we created initially was adapted to that need. But then we discovered that the claims process also, in being done by sort of a traditional carrier, has all of this friction associated with it. So a big strategic decision for us was to actually deliver that claims experience by our staff, by our team, and ultimately through our technology. And the only way to truly enable that was to do that from top to bottom. And some of the challenges in the industry is that there are these incentives set up between carrier and agency that are not well aligned sometimes. And so in order to really do the full stack, meaning handling claims and all that, you need to actually hold the risk. And so in our case, in order to bring that claims experience to market, we needed to actually bring the carrier in-house as well.
Daniel, do you want to elaborate on that as well?
Yeah, I agree with everything that Dan said. I'd add that in our case, we were doing some business model innovation as well, which meant that we are skeptical of the notion that you can take this 100-year-old edifice, pixie dust style, sprinkle some technology on top and think it's going to affect a dramatic change. It's a good thing to do. You should add technology to the existing stack, but there's a glass ceiling to how much change you can really bring about if you're not going to go and do the hard work of the plumbing. I think Dan's point about claims is a great one. So today, and it's still early days for us, we haven't been in market that long, but about a third of our claims, close to a third of our claims are paid algorithmically, instantaneously, money in your account 3 seconds after you submit the claim. getting to that kind of transformative experience is, I don't want to say impossible, but near on impossible if you don't control the whole stack.
Yeah, I would agree.
Jamie, also life insurance is a super capital-intensive business. So when you thought about structuring Ladder, how did you decide to do that?
So we started out very similar to where Metromile started out, which is with a partner carrier. But we wanted to make sure that we could have a full stack solution. So we rebuilt everything from claims, administration, policy management, payments, you name it, up and down the stack, to be a fully digital experience so that we can both take the costs out of the process and really enhance the customer experience. That allows us to take that 8-week process and crash it down 10,000 times. So we can give you a decision in 8 minutes. And that's just fundamentally different and something you can't do by just trying to put a little bit of a front end on these really very kind of old school pieces of kind of back office technology.
What I'm wondering also, Dan, you and I were talking about this just yesterday. How many people does this require, and where can technology kind of take the place of where more costly things used to really exist? Frankly, where people used to exist.
Mm-hmm.
So where can you cut costs, from starting from the ground up, versus the much bigger incumbents that you're heading up against?
For sure. And I think Daniel's point on claims being done in such a short amount of time is a really important one. In order to do that, not only do you need the systems to be able to algorithmically pay that instantly, you also need to replicate the human decisions that go behind them. And so typically a claims process has a number of checks. You ask the customer what happened, you ask witnesses, you look for camera footage, you look for all of the evidence you need to be able to show that that claim happened as the claimant said it did. But if you can model the physical accident or what actually happened, you can verify what the customer just told you with what actually happened. And as long as they're okay with you using that, you can use the systems to automatically pay that. And so a lot of what is driving us forward in not sort of building up that massive sort of operation is replicating or improving upon the human decisions that would be necessary in most of those cases. Now, it doesn't solve all of the problems. If you model anything, you'll find that things on the edge of the distribution are really hard to model. And so that's when you need the experts, right? That's when you need really great claims adjusters that have great tools to be able to help customers through the more challenging claims.
Maybe just a layer on top of that a bit. I don't think this is radically different in auto, but in homeowners at least, the expense ratio is about 30%. AM Best puts the national average at 30%. So for every dollar you pay, 30 cents gets paid, is spent by the carrier on themselves. Salaries, bonuses, private jets, the whole 9 yards. Another about 12%, 10 to 12% is spent on something called the LAE, which is the bureaucracy of paying claims. Not the claim itself, it's a bureaucratic overhead of paying claims. Now, I understand why the structures are that way, but you wouldn't start a company like that today. And I do believe that the companies and the technologies that you're seeing pop up, including my colleagues here, will show a way to collapse both of those by a factor of 10. I mean, I think it's orders of magnitude difference when you start from scratch, because you just wouldn't build it that way. So you'd use bots instead of brokers. And one of the benefits of what Dan was just talking about, when you can algorithmically pay a claim, you win twice. One is the consumer experience is revolutionized. Instant payment is delightful, it's surprising, people tweet about it, it lowers your cost of acquisition, has a lot of good benefits. But not only have you delighted a customer, you've collapsed cost. So you end up with a kind of a disruption, which is typically low-end disruptions are an inferior experience, but at an unmatched price point. Here you're getting to a cost structure that is unmatched for superior experience, and that can be incredibly powerful.
I was going to get to this question later, but I mean, I guess the story of data is really underpinning everything we do here, right? So, data and AI and machine learning, these have been huge buzzwords in the industry, and a question we have for everybody is how they're using it, right? Whether it's how you each use it yourselves, all the data you're collecting about the customer experience and whatnot, or what you're seeing other carriers doing, what's really impressing you in the industry in terms of how we're using data? Jamie, do you want to get us started on that?
Sure. What amazed me as we got into this was actually you would imagine these 160-year-old carriers would have these incredible data warehouses with great texture and richness to them. Because fundamentally, we are in a data business. And for a lot of legacy reasons, they don't. Their systems don't talk to one another. One of our customers was frustrated with his traditional carrier because he wanted to go paperless. And it took him 5 pieces of paper and 5 calls to the call center to go paperless. So, one of the ways we're really leveraging data is around customer experience, right? How do people want to engage with us, and how do we make that a really delightful, easy, straightforward process that you really understand? It's highly transparent, because that's kind of what our customers are really looking for. So that's kind of one of the ways we're fundamentally kind of leveraging that data to create gains for both us and the consumer.
Another way I'm curious that you answer this question too, Dan, is because you came from a machine learning background. Are there ways that the insurance industry is not catching up to other industries?
Yeah, I think one of the important distinctions is that when you build a data science team or an analytics team, and your sole job is to model data and understand it better, that's all it is analytics. To really get the benefit of what you're modeling, it's a software engineering problem just as much as it's a modeling problem. And so, for instance, our machine learning or data science team, everyone on that team can write code, and they submit production code every day as part of actually modeling that. And so I think it's critical to think of this sort of AI as part of the actual product you're building, not just like a separate siloed analytics function, which has been around for a long time. You're just getting richer or better data now. It requires an entire transformation of how you actually think about the product that you deliver and incorporating that in the actual development of it.
How about you, Daniel?
Well, I'll just add, we've got a much easier job than traditional insurance companies. Starting from scratch and being legacy-free is incredibly empowering. And I do not envy our opposite numbers, the chief digital officers in the large companies. I wouldn't trade places, I wouldn't know how to do it. But I do meet with them and I hear their stories, and you just get a sense of just how radically different their lives are than ours. So job number 1 is finding COBOL programmers, because the code base needs to be maintained and was written in the 70s and they don't exist. One guy told me about an integration that took them forever with Salesforce because they needed to integrate with JPL. And I said, what is JPL? He said, it's Jim's programming language. Some guy named Jim invented a programming language, died, but
his legacy lives on.
And his legacy lives on, exactly. So I think when you understand those difficulties, starting from scratch with today, we've all been in tech for a while. Writing software today and writing software 5 years ago, there's almost no commonality. So if your systems are more than 5 years old, let alone 50 years old, you're just so encumbered by legacy. And I think the broader point here is that a lot of the assets that insurance companies built up over years are now transforming themselves or revealing themselves to actually be liabilities. So the technology stack was a matter of pride, now it's an albatross around their neck. The distribution platform, all the brokers, was a matter of pride, it's an albatross around their neck. And I think we're seeing that time and again, that systems that were assets are actually revealing themselves to increasingly be liabilities.
And I think what you're hearing here is data is fundamental to what we do. It is not a feature or a small part or something we added on an AI feature. We added on like a bot. No, it's fundamentally to how we think about our business in every regard. So it really is the fundamental basis under which we build up all of our businesses. So I think that's one thing that I found talking to some of the traditional players. We really miss each other when we talk about data and we talk about how we're designing our product and processes.
On that note as well, a common theme with that is you have a constant in comparison to what the larger guys can do and what they have and haven't been doing with data. And I'm wondering, where is there opportunity for them to partner with you? We've seen this in a couple ways, right? Daniel, one of your investors is Excel, big established insurer. Of course, it started as a startup as well. But I'm very curious to see how you guys are able to interact with the much larger incumbents and from your perspective, Dan, when it came to working with a larger carrier and then deciding to go out on your own, are there still opportunities for partnership here? Do you want to get us started, Daniel?
Sure, I think it varies greatly. Different insurtech companies will have different answers for that. We have gone the route of being a full stack insurance company. Reinsurance partners are cardinal to our business model. Excel has been a phenomenal both investor and partner. So we have tremendous time and respect for both XL Catlin and more broadly for our reinsurance partners. We haven't had much opportunity or need to partner with carriers that are writing policies themselves. So we have a lot of respect for them, and they're formidable competitors, but they are competitors rather than partners in the way we do business.
What are some of the things, though, as Excel, as a investor, and even some of your reinsurance partners, right? Berkshire Hathaway, for example, Warren Buffett. Is there anything you've learned from working with them throughout the last year and a half or so that you'd be able to share?
No doubt. So in the case of XL Catlin, Tom Hutton is the partner there. He sits on our board. I think I was mentioned to you backstage as well. He's the only person I know who is truly bilingual in technology and insurance, and he speaks both without an accent. So having that kind of persona on our board has been phenomenal for us, and particularly you start off by asking us about our newness to the sector. Coming as a total outsider, you do need somebody on the board in your investor category who has a deep understanding, can steer you to the right partnerships and the right business models, and tell you where the mines are, because there's plenty of mines in the water. So for us, it's been a tremendous benefit.
Dan, is there anything that you've learned from the insurance industry or your work with other insurance companies that?
For sure, all along the way, actually. Everything Daniel said about having advisors, board members, et cetera, who are really knowledgeable in insurance can help guide you through each step. We certainly went through many stages in our business, from inception to now being sort of full stack carrier, where you have all sorts of startup constraints. Having an organization that can handle claims for you. In auto insurance, there's all sorts of weird things that happen, and there are times where you need lawyers and others to be able to do this. And so you either need to work with a third party, which oftentimes has the wrong incentive, or you need to work with somebody who has aligned risk with you, and that's typically how you get into an MGA, or managing general agent, and carrier relationship, which is how we started. And we're very appreciative of the partnerships we had from the beginning through to where we are now. And even now, you have capital constraints as you're a carrier and need to hold surplus in that carrier. So reinsurance partners are critical, and looking at capital partners in different ways throughout sort of that whole chain is critical. And I think every insurtech startup is going to find that in their lifetime, they will work with a number of different partners that they need to be able to get to that point. There's really no way around it.
And Jamie, from where you're sitting too, so many life insurance companies have so many venture capital arms as well.
They do.
Front row seat.
Yeah, so I think reinsurance is a common thread you're going to hear from us, and I think other insurtech startups. As you think about issuing your first policy, there's an enormous amount of idiosyncratic risk around that first policy, up until you have a really big diversified book. So how do you deal with that? You deal with it through reinsurance. And those are great partners that have really efficient books of business where you can diversify that away. So you can offer great pricing to your customer. And especially us and a lot of the new startups, we don't have a lot of legacy costs that we need to embed on those prices. So it's a really efficient ecosystem for us to be able to offer really great rated paper to our customers, and then really leverage those efficient ways for us to reinsure our risk.
If I could just pick up on one thing that Jamie mentioned earlier, I think for sure, for reasons that we just outlined, they're a key part of each of our companies. I don't know about you guys, but we've always felt, though, that there's a black hole that has the potential to suck us back in, and that we haven't yet reached escape velocity, and we have to keep kind of fighting that. What I mean by that is that you want to absolutely partner in the right places and borrow the right elements. But for us to achieve what we're trying to do, we can't become another insurance company. And Jamie mentioned earlier that we're data companies, we're technology companies who are doing insurance. That's not just a turn of phrase. That's a different philosophy, it's a different approach, it's a different stack. Yeah. When we ask ourselves a question, we need another customer support person, or we need another claims person, we need another finance person, almost always the answer is we actually need another engineer. And engineering is not a cost center, that's the core, and that's what's going to do customer support and finance and everything else. So yes, we need insurance partners, but we also have to be sufficiently independent of them and separate to them.
Yeah. I would bet for all of us that engineering and product teams are probably the vast majority of our teams. And I think you talk to an insurance carrier and say, great, of all the people you have working with you, how many are engineering, how many are product people? And I think you'll get a very, very different answer.
And product means two different things in insurance.
Oh, that's a great point. Yeah, we should really hit that, because product to an insurance company means like the legal piece of paper and the actuarial pricing. And all of us, that is like That makes no sense to us at all. Product is the whole thing, how you interact with your customer and how you, that conversation.
Yeah, user experience, product design, technology.
That's exactly what I wanted to ask about next. If all of you can kind of go into that a little more. I remember when you launched, Daniel, how easy it was to use, right? When you got, is that, how much of, what you're building is what you're offering the customer the minute they pick up the phone?
Well, maybe I'll just build on the previous kind of couple of sentences. With us, we do not start with an insurance product. We start with sketching out a consumer experience. So my co-founder, Shai, is just a phenomenal user experience guy. He's a phenomenal technologist. He's phenomenal in many ways, but one of them is really understanding consumers and their flow. So it doesn't even start with technology. It starts with what is the user experience that we want. Then that then goes to be both coded and designed and to get the compliant product from an insurance perspective. But that is the entirely absolute opposite way that insurance is typically done. Insurance starts with an insurance product, and then you say, okay, build a website for this. So it is absolutely the other way around. And that's why you end up with an experience that is so consumer-friendly, because it started with a consumer-friendly experience. Everything else was built and was forced into that rather than the other way around.
You can't take a legacy product, stick some front end on it, and think somehow that's going to magically work. It needs to be fully aligned. And I think we're all relentlessly focused on meeting the end consumer's demand. And for us, the consumer is actually the end customer. It's not distribution. Like, you have insurance companies that talk about who their customer is, and they talk about distribution, agents. That's who they're spending a lot of time with and building things for. And that's, I think, pretty fundamentally different for all of us.
So another thing, too, is, we've seen from CB Insights that, in 2012, since 2012, there's been $7.2 billion raised across 620 deals, right? A lot of this we've seen in the last year and a half, right? And from your perspective, and we get this question a lot from the larger carriers as well, does InsurTech have a lot of room to run? How, is there a lot more on the horizon from your guys' perspective? And what happens to all these companies? Do you see a lot of you guys or your peers being acquired by the larger carriers? Do you see more IPOs? Where does the industry go from here? Want to get started?
You're looking at me. It perplexes me. I don't actually know where all this money is going. I don't know where all these 600 companies are. We're not encountering them in the market. So I read the same reports, I see it, but I can't tell you that I encounter many other insurance companies in our spaces. There's a few names, and they didn't raise $7-point-something billion combined. So I do find that confusing a little bit, and I'm not sure. I think because InsurTech is a hot sector, a lot of companies that are doing all different stuff, whether it's machine learning or risk analysis, all of them, they all paint themselves as InsurTech, and then the numbers can add up pretty quickly. But I think my sense of this is that insurance is going through some meaningful changes. And I've heard a quote attributed to a dozen different people, from Steve Jobs to Bill Gates. I don't know who originally said it, but they said that oftentimes technology companies will disappoint or will appear overhyped in a 1 to 2 year horizon, and then they'll over-deliver in a 10-year horizon. And the Gartner hype cycle looks a bit like that as well. And I imagine that you'll see something similar happening with insurance. I think that at the moment it's very hot, and then in a couple of years people say, oh, where's the big difference? And turn around in 10 years and it will be different. And I don't think that there will be Wikipedia-style different, where a Britannica disappears overnight and it's all Wikipedia. But look at what's happened to retail and Amazon and how many years it's taken, but what's happened subsequently. And I wouldn't be at all surprised if we turn around in 10 years' time and the insurance landscape looks very different, and the market caps of the different players has changed beyond what people might estimate today.
Yeah, I'd agree with all of that and add, there are a number of new entrants, whether it's direct-to-consumer products or other distribution plays, and a lot of back-end software too, which is probably where a lot of that investment went. From the perspective of building a new carrier or an agency, it'll be interesting to see how many of those companies end up with truly different products in the end, and not just different spins on the actual distribution. I think all the companies here represent truly fundamental shifts in the underlying product. And I'd be really interested to see in 10 years, for instance, how many of those stories have evolved to maturity. Yeah.
And I think, that sounds like a big number, but when you look at venture capital as a whole, that's probably 75 basis points, 1% of total venture capital. Insurance is about, 3% of GDP. So you also could say, like, that is a really big space that has not had a lot of innovation for a long period of time. So, you know, from a relative share perspective, you could actually say, you could make the argument it's under-indexed. And I think investors are smart people. They look at industries with high expense ratios, low customer satisfaction, low customer engagement, but yet fundamentally good and valuable products where people are better off by having them, right? All of us are better off by sharing this risk together in these pools. So I think you're going to see probably more, not less.
Thank you guys so much for being so candid with us today. Looking forward to hearing from more of you soon, too, and talk to you soon.
Thank you, Sonali.